we've actually expanded our remit. We're the mining, metals and industries team. And that's about looking at where those minerals go downstream into electromobility. And again, really just embedding into our business model the ESG aspects.
What are the issues? Are those issues being remedied? Is this company vital for us to meet our net zero targets? Is what's important.
For me, corporate governance is essentially the foundation of good sustainability performance, in that it gives confidence that environmental and social targets, objectives, policies and frameworks are actually going to be implemented.
Hello and welcome everyone to another content session for the one-to-one mining investment online APAC event, co-branded with the Assay Live. Today, to speak on the role of ESG, we have Deborah Cottle, Managing Director, Regional Co-Head of Mining, Metals and Industries for Asia Pacific at Société Générale. We have Wayne Gordon, Senior Investment Analyst at the Chief Investment Office, Global Wealth Management at UBS, and Gabriel Wilson-Otto, Director, Sustainable Investing at Fidelity International. So thanks to our panelists for taking part today.
Thanks, Amy.
Thanks, Amy.
And so really, this discussion today is going to look at the role of ESG and the growing demands for accountability in the industry. So to kick things off, I wanted to ask, how is ESG integrated into the decision-making and investment process that you and your teams follow? And I guess as a follow-on to that question, how has ESG investment evolved over the past few years? And do you see it as more or less of a formal process now? Maybe Deborah, if you want to kick us off today.
Yeah, sure. Thanks, Amy. And it's a great question. And I believe it's important to remember that ESG is not a new topic for the mining industry and nor for the banking industry. Environmental, social and governance related matters have long been at the centre of SocGen's assessment of opportunities. Mining project financiers have for many years imposed project-specific environmental and social requirements on their borrowers, including things such as environmental and social impact assessments, environmental and social action plans. And we have a number of defined guidelines and policies which set the key standards and parameters for responsible engagement with our clients. And if we look back, even as far back as 2007, we became a signatory to the Equator Principles. So as I say, this is something that we've looked at for a long time, evaluating impacts of biodiversity, cultural considerations, tailings disposal, occupational health and safety for workers. So really it's been integrated into the bank's decision-making processes for quite some time, but certainly the topics become more and more of a selection criteria and really at the centre of the discussion. And I think this is true of the whole industry, for shareholders, for institutional investors, really demanding more emphasis on the environmental, social and governance aspects, becoming undoubtedly more of a major driver of those decisions, with the bar continuously being raised. And so whilst the process has always been quite formal, I think it's fair to say that it's now become more comprehensive and more stringent in terms of what we look at doing.
Gabriel, do you want to follow on from that?
I completely agree with Dev's comments in that for us, and I think for the industry in general, ESG is not a new topic, but the way that it's been implemented and how it's been implemented has evolved over the years. And if we look back to sort of like the 80s and 90s and early 2000s, where the bulk of assets that were in ESG or sustainable products were much more about value alignment and making sure that you either excluded certain activities or skewed towards other activities. What we've seen is more of a formalization of the type of fundamental risk mitigation and analysis of ESG's topics into everyday decision making. And so I would argue that historically, a lot of ESG issues, such as whether it's waste management, tailings, environmental, human capital issues, or corporate governance, were all considered as part of fundamental business analysis, but the data to support it might not have been as rich, and the frameworks used might not have been as comprehensive. And so for me, the biggest shift has been the mainstreaming of some of the data and tools that have facilitated more structured analysis and more quantitative comparison of how issuers are performing on these topics. And the other big shift that I've seen is also increasing client and regulatory interest in these topics. And so the reporting requirements for a fund has increased significantly. So our clients are increasingly asking us for very granular detail on individual metrics for the mining sector and others around how their funds and investments are actually performing on these credentials, alongside reports on more fundamental measures of alpha, performance and risk. And so I think that mainstreaming of understanding, increasing burdens on reporting, and also the increasing financial materiality of a lot of these issues as the regulatory risks increase and also as consumer preferences start shifting and impacting demand. I think that there's a lot going on that has now been incorporated in a more structured way. And a lot of managers such as Fidelity International and others are using proprietary analysis and ESG ratings and research in order to try and build up their own database and analysis in order to meet those requirements.
And just as a quick follow-on, you bring up kind of regulatory changes and stuff. What were some of the main drivers that really brought ESG into that mainstream discussion?
I think that for me, I'm very keen to hear the other panelists' view on this, but I think it's differed by region. And so if we look at what happened for example, I'm based in Hong Kong, if we look at mainland China and other markets in the region, it was really a shift in government policy towards environmental protection that started in around 2013, 2014. And what that caused was increasing changes to competitive advantage if a company was dumping toxic waste or not living up to environmental or social standards. And so that tightening shifted the industry's focus on how they need to operate and what a sustainable business actually meant. In other parts of the world, we've also seen, if we take Australia, for example, from my experience, it's been a lot more driven by the investor side, where retail investor standards around having coal or fossil fuels in an investment portfolio or exposure to tobacco or other topics have meant that they've put a lot of pressure via the superannuation funds onto asset managers around what constitutes a sustainable portfolio. And I think that flow has impacted the political debate as consumers have shifted, and also as national objectives have shifted. And the biggest round of this at the moment over the last 12 or 18 months has been evident through the net zero commitments at government. And I think that that's a combination of shifting, increasing confidence around the science of climate change and more evidence and proof that makes it irrefutable. Also increasing awareness of the impacts of climate change, whether this is through bushfires in Australia, flooding in Europe and China, increasing typhoons like we have today in Hong Kong. All of these sorts of issues make it a lot more clear that climate action is required. And I think that the governments are starting to respond to those sorts of pressures and initiatives globally as well. So a bit of a confluence of factors.
Great. And Wayne, let's bring you in here to hear your thoughts on the.
Yeah, I just want to pick up on something that Gabriel said and Deb said, that, you know, obviously from the institutional side, this has been a long I suppose, a shift that we've noticed for, you know, as Gabriel said, it started back in, you know, the early sort of, I suppose, 2010 and onwards. And increasingly, you know, we've been, again, improving our in-house metrics that we use to look at companies and sort of look at impact that those companies are actually having. On the private bank side, I would argue that COVID was a bit of a watershed moment for a lot of people on the wealth management side. I think there was definitely increasing interest in investing across the board in various segments such as materials, mining, consumption as well, and the food industry prior to COVID. But I think the COVID-19 pandemic was a little bit of a shock to the system. And I think people pretty quickly saw that how supply chains are very fragile and the impact that supply chains are having on the food you eat and the products that you use. And so since the pandemic began, we've seen a significant shift in investors' attitudes to wanting to have pure exposure to sustainable portfolios, whereby, at UBS in particular, it has been our preferred portfolio for some time now, and the interest across the board in not just investing in a broad-based sustainable portfolio, but also in individual sectors. And just to pick up a little bit on what Gabriel said with respect to, as an asset manager, how do we used to think about unfavoured sectors or sectors that we considered to be doing harm to either people or the environment. They were pretty blunt instruments initially. So excluding sectors from portfolios and so forth was pretty much as detailed as it got. These days, we're a little bit more pragmatic in that context. We recognise that some companies are doing enormous amounts to try and get themselves towards net zero, particularly oil and gas, where most large oil and gas companies, most large commodity traders, food producers, all have ambitions for net zero, many of them before 2050, and they're taking really active steps to get to those ambitions. And from our perspective, we don't necessarily want to exclude sectors such as energy necessarily. What we want to do is we want to encourage those companies to move more in the direction of having greater impact, and so as a consequence, we want to sort of in some ways reward those companies that are really pushing the boundaries here, trying to extend technology and bring about those ambitions of net zero. So that's how I suppose we've sort of evolved in this. That I guess we've had to in many ways dig deeper into the detail, and as Gabriel said, a lot of that detail now we've seen improvements in public access to better ESG data, as an example, but then even in-house, we too have sort of wanted to dig and segment that up a little bit more, and try and have greater impact in those areas which, like energy, for example, and materials, where they are significant contributors to emissions. Yeah.
And I guess following on from that, do you think that ESG compliance and these types of criteria are going to be the only way for mining and other types of industries to receive funding moving forward? What about the more fossil fuel intensive industries? Do you think, in terms of the mining industry specifically, do you think there's been more of I suppose the communication in terms of what people are doing in terms of ESG? How has that kind of helped matters? Because I think there was a communication issue kind of throughout the years in terms of what the mining industry was doing, and how they're in terms of ESG metrics. What are your thoughts on that?
Well, maybe I should start. Maybe I'll start, Amy. Yes, I think there is, particularly from the private banking side, there is definitely a desire to go look at your portfolio and I suppose adjust it in a way that improves the overall impact for the environment. I think from a funding perspective, it has got definitely more difficult. And we've seen in particular for oil and gas, a lot of oil and gas producers are now carrying more cash on the balance sheet. They are looking to self-fund some, extensions of some projects because the public funding markets are a little bit too onerous. I guess my point is that as we look forward over the next decade, my preference is to make sure that the best projects are being funded, which may, in the end, we are going to require fossil fuels. We are going to still need fossil fuels as we go forward over the next decade. The transition is going to take time, and there are a lot of impacts that we can make, even in the production of fossil fuels, to do it better and reduce overall emissions. And those projects, I think, deserve consideration in the funding markets because that is the pathway that we will need to take. We're not going to simply move to EV vehicles in overnight. EV vehicles and electricity production is not going to move to complete renewables overnight. We've seen the issues recently with sharp increases in gas prices and coal prices, largely because we have had significant underinvestment in the sector over a couple of many years. Now, that's appropriate in some areas, but in other areas, we do need to maintain funding to the best projects that not just produce the energy we need in the short term, but have the lowest environmental impact in the longer term. And I think those projects are something that as bankers, we need to be very pragmatic about and continue to try and push capital in that direction, while at the same time trying to make sure that renewables projects and so forth receive the lion's share of funding as well. Yeah.
And I just completely agree with Wayne's comments. From my perspective, the way that I typically look at this is focusing on what is the transition pathway away from fossil fuel and other sorts of more harming sources of energy. And that's exactly aligned with Wayne's comments around looking at what is the harm of different parts of that complex. If we assume that we need to transition and that we need to transition rapidly and with a strong level of ambition, what does that roadmap look like? And I think that it's very important to take into account that even in a lot of 1.5 degree scenarios or net zero scenarios, fossil fuels remain part of the energy complex all the way up until 2050 or 2040, depending on which model or approach you want to take. And for a lot of these, but it's important to look at within that complex, you do see much more rapid phase out of coal-fired power generation. And so it's almost a case of taking the least bad outcome in order to try and rapidly transition, which could lead to funding towards some fossil fuel assets, which are either low on cost curve and also low on environmental impact. And this is what we're actually starting to see as a more nuanced approach from the asset management community around excluding areas such as oil sands and unconventional oil and gas, Arctic drilling, those sorts of components, and thermal coal, but not having blanket bans or exclusions on the broader energy complex. And I think that reflects the shift from, in part, a blunt tool of engagement, exclusion, and divestment, more towards an engagement-led approach, which is essentially trying to figure out what is the ambition and strategy of the company to be part of a solution and to be part of a transition. And I think increasingly that's what investors are looking for in terms of allocating capital.
Yeah, it's interesting, I think, looking at it from the lender's perspective around ESG compliance and the criteria, and certainly, ESG has become essential in everything that we look at, and really quite central. And if I think about some of the targets that the bank has made, for example, to commit 120 billion euros to the energy transition between 2019 and 2023. So it really is about being, part of the change that we see, and even, looking at our business models, things such as the mining and metals team. We've actually expanded our remit. We're the mining, metals, and industries team, and that's about looking at where those minerals go downstream into electromobility, and again, really just embedding into our business model the ESG aspects. So certainly having ESG alignment, I believe, is really critical and becoming more of a gating issue to get access to the capital.
Fantastic. And I mean, are there specific metrics that you look that you use to kind of judge companies or projects or other, various metals that you might be looking at? Are there metrics that are kind of strictly adhered to? Is it more of a holistic process when you look at these types of projects?
I guess from our perspective, we're not necessarily looking at metrics. It's more of a qualitative approach that we take, because we're not seeking to rank companies or projects, but rather trying to ascertain whether their ESG performance and management is acceptable and in line with our internal requirements. So reviewing things such as sustainability reports, whether available climate change reports, and the environmental and social management practices of the company. And that ESG performance is actually a good proxy for good management and for good risk mitigation as well within a company. So we don't necessarily look at metrics, but it sounded like from what Gabriel was saying earlier that perhaps they have some more metrics that they're looking at.
Yeah, for us, I think that what could be helpful is if we look at, if I first talk to what is more industry standard from a ESG scoring or quantitative framework, the Sustainable Accounting Standards Board, or SASB, is becoming a little bit of an industry standard as a starting point or jumping off point for what determines the best metrics to look at and the most financially material metrics in each sector. If we look at mining and extractives, it's not surprising that for environmental issues, they focus on areas such as greenhouse gas emissions, water and waste, tailings, hazardous waste. If we look at the social pillar, it's more of a focus on fatality rates, lost time frequency rates, all of these sorts of elements that get bundled in. I think that would form the basis of the approach that most people in the industry and most rating providers would use when they're assessing from a very, very granular perspective a company's performance. The challenge here is actually that we always find is, and this goes to Deb's point, is that how do you actually, are those metrics an accurate and telling and insightful reflection of the company's general strategy and how they operate and what they do? And is this reflective of a broader approach that a company has taken, which could be an indication of very strong strategic engagement with the underlying issues, which could lead to significant risk mitigation or impact and harm mitigation? And often a lot of these issues will depend on the exact context of a company, the market, the niche that it's operating within, the country that it's operating within. All of these sorts of metrics really do need qualitative analysis. And for us, that's one of the reasons we rely heavily on corporate engagement in order to kind of cut through some of those biases that might exist, or the incomparability of a lot of the data or issuers. So I think that they're a good guide as to what some of the top level metrics people would be focusing on, but also I'd just like to make a strong call for people not just to focus on good being a low greenhouse gas emissions number or a low water number. It needs to be taken into account the context and how you're operating and what you're doing in order to really understand what's going on.
Wayne, do you have any follow-on to that?
I just picking up on something that Deb said before with respect to the transition is going to be incredibly metals intensive, and we know that producing these materials, such as lithium, cobalt, and so forth, these are going on in often very difficult geologies and often very difficult social and geopolitical environments. I think that from that perspective, I completely agree with Gabriel that one size doesn't fit all here. Like Gabriel, across UBS as a bank, we have an investment bank, we have an asset management part, we have a wealth management part, and from our perspective, it's putting all of those, I suppose, all the information together, particularly around engagement, and particularly around how deeply we look into each individual company. I guess we take a little bit of from the top-down approach. We tend to be, I suppose, delineating companies that we are interested in when we're putting together what we see as an appropriate portfolio for a particular sector. And then, of course, you start the process of digging into the company itself. A few things that, and perhaps not specifically to the mining sector, but with respect to things like food, for example, where a number of companies will have a poor ranking because of legacy court actions or legacy issues with businesses that have been significantly improved over the years. And this is where I agree with Gabriel and Deb in this point, is that, if you just look at the top-down ESG ranking, some of these companies are vital for the transition to maintain food security in the context of materials mining, vital to delivering the metals we need, because we know that EV cars, for example, have 4 times the amount of copper that traditional semi-combustion engine cars have. So that's where we've found the necessity to look on an individual company basis once we've sort of segmented up the companies of interest. And often you find, particularly in a food company that I'm thinking about, when you dig into their sustainability practices and the announcements they have in their sustainability plan, it's actually very impressive. And just segmenting that company out of a sustainable investment portfolio would be the wrong call. And I think that's where the discretion of the manager and having that flexibility to look more deeply into what are the issues, are those issues being remedied, is this company vital for us to meet our net zero targets, is what's important. So, yeah, I completely agree with Gabriel and Deb on those points. Yeah.
Can I just jump in very quickly, because I think that Wayne made a fantastic point, which is that ESG rating providers like to tell a story about a company, and often that can be based on very out-of-date data. I've seen, they do a fantastic job of what they're trying to do, but if the data is not available, it really constrains the ability to have insightful ratings. And I've seen examples of companies that are still being pinged for a controversy that was 5 or 10 years ago, and the entire senior management team has turned over. And so is it really still a corporate governance risk that an ex-management person did something that was a little bit below par? So for me, I think that the critical thing for issuers here is to be telling your own story with regards to your sustainability credentials, your profile, and what you're doing, in order to ensure that investors and third parties, civil society, government can actually better understand the way these issues are strategically integrated into your operations and how they're influencing outcomes. And for me, that gives us a lot of ammunition in order to distinguish between better performing players within the industry, and also to be able to understand how companies will be sitting within that transition. Because I think a point I love that Wayne made was that a lot of these companies, there aren't substitutes that are commercially viable for the business activities that the companies are doing. And so if we assume that they have to be part of a solution, whether this is climate change or alleviation of poverty or any other big industrial development projects, the question becomes, how do you perform that in the best way that minimises harm? And so I think that being able to have the data and the information and the narrative around how companies are contributing and can see that transition pathway away from more harmful activities, for me, that's what I'm always trying to look for when I'm looking at issuers.
Absolutely. I mean, it really brings to mind like the issue of cobalt required for EVs, and I suppose how do you measure that risk in terms of getting involved with companies maybe in risky jurisdictions, and perhaps where you can't get all the information that you require?
For me, when we're looking at these sort of risks, it really comes down to what are the minimum standards and how could this actually be impacted. So first up, what is the fund and investment opportunity that we're looking for here? So is it a more mainstream fund where the objective of ESG integration is primarily risk avoidance? Or is it a fund where we're trying to actually have genuine positive impacts and positive outcomes, and we're more impact or thematic focused on what we're trying to achieve? And I think that that's an important distinction because it can influence how you interpret or evaluate the potential risk of different markets. And so if we're looking at a challenging jurisdiction, there are some markets that we typically just fall into a too hard basket in that we are unable to genuinely assess the risk, which means that it becomes very difficult to try and price that into an investment decision. And so if it's purely a fundamental decision, it can be difficult. On the other side of things, if we're looking more at positive impact, it comes down to a decision of weighing up how much is this company actually contributing to the local communities and what is it doing in terms of the positive aspects, weighed up against risk of corruption, human rights abuses, other sorts of issues that could be going on. And so again, engagement here is absolutely critical to understand the credentials of the issuer, how they're navigating these challenges. And what we typically try and do is to evaluate it from more of a fundamental perspective to see how do we weigh up the pros, how do we weigh up the cons, to make sure that sustainability considerations are baked into that long-term decision-making process and engagement process. But again, unfortunately, there's no simple answer here in that often it's case by case, and often it comes down to a conclusion that the risk is very difficult to identify or actually put a probability on the adverse event occurring.
So, I mean, we've talked quite a bit about the environmental side, which certainly is kind of taking the front seat in a lot of the ESG discussions. I wanted to bring in a little bit more of the social and governance, and talk a bit about kind of what you guys look at in terms of those criteria. Maybe Deb, if you want to start us off here.
Yeah, sure. And as you say, I think a lot of the conversation has focused on the environmental side, and perhaps that's because it's, I guess, overweight in terms of when we look particularly at mining companies. It's obviously linked to the activities. But certainly the social and the governance aspects are very important as well. And we only have to look at some recent examples in Australia, up in the Pilbara region, which really highlighted some of those, the importance of the social impacts, both from an investor's perspective, but really from that stakeholder engagement side of things. So I think we've seen it coming onto the radar very acutely, and a lot more focus now on the social aspects as well as the environmental. And in terms of our assessment, it is across the spectrum of ESG. As I said before, when we look at aspects such as governance, we're really engaging with management teams, with boards around their reporting, what they're doing, doing a lot of due diligence around the company's policies, procedures, management, which includes the governance aspects of sustainability committees, the composition of boards as well, and looking at that to get an overall sense of that ESG profile of a company. And we've seen obviously a lot of activity in that space as well. I think, as ESG has come more and more to the fore, we're seeing people, reviewing things such as board composition, the way in which they are establishing their governance, the number of independent directors on boards, really, trying to address all aspects of ESG.
I guess I would just quickly say, Amy, in support of what Deb has said. I think the governance side is probably, from our perspective, if a company is scoring well on governance, it tends to score quite well on other metrics as well. And governance, and particular for reporting for public companies and so forth, is something that Asia has come a long way on. From a regional perspective, Asia has come a long way in the last decade. In the US, companies report regularly. In fact, probably they over-communicate to the market, to the point where company results come out and very rarely you get big significant surprises unless there's been some macro events that have impacted performance. But what we've seen in Asia is that companies in particular have often started as family businesses or private companies and have come to the market as now public companies. And that has that's seen a significant shift in the improvement of reporting, as well as Deb said, with respect to composition of the management teams and so forth. And so while the environmental issues have been extremely important, particularly in our region, actually governance in my mind has been, if not more important, and we have seen that significant improvement, and that is a work in progress. So as example, sitting here in Singapore, Singapore regulators have moved to improve the reporting of environment, social and governance metrics and so forth by the companies who are based out of Singapore. And that's a significant step forward to not just give investors more confidence that what people are saying they're actually doing, but also providing that improved impact, and it improves share market performance. One of the key things that we've noticed across the board in our portfolios, and part of the reason why many years ago we began to advocate clients simply completely shift their portfolio allocations to focus on sustainable investing, is because the performance of those companies with better governance, with better social metrics, with better environmental metrics continue to outperform the broader market. We've seen that amplified through the COVID pandemic and the crisis associated with that. And we expect that to continue to generate returns for clients above the normal portfolios going forward. So I think that's one thing that particularly on the private banking side has become very apparent during the pandemic, is that outperformance, and that outperformance is now being recognised by the clients. Hence, we're seeing this significant shift, not just because it's the right thing to do towards sustainable investing and impact investing, but because it provides lower volatility in an overall portfolio. And that's something that we all strive towards: better performance and lower volatility with greater impact for those environmental and social goals that we pursue. And so I think that's been the driver to private clients really getting on board with this over the last probably 3 to 5 years. Yeah.
Gabriel, did you want to follow on from that?
I'd just like to echo one of Wayne's points that it really resonated with me, which is that for me, corporate governance is essentially the foundation of good sustainability performance, in that it gives confidence that environmental and social targets, objectives, policies and frameworks are actually going to be implemented, and that the culture of the company is more likely to be that of proactively addressing and dealing with these issues. And so this has actually been reflected in a lot of both regulation in individual markets across Asia Pacific and globally, but also in global initiatives that are targeting environmental or social outcomes. So for example, the Task Force on Climate-Related Financial Disclosures starts with the governance of how you're going to deal with climate change and mitigation and scenario analysis and risk assessment. But it really highlights that any type of project like that needs to start with the board and needs to start with who owns and who is responsible for the initiative. And what we're starting to see is the emergence of more and more sustainability committees on boards in order to deal with that function and to provide more direct oversight throughout an organisation. And for me, I think that corporate governance is something that has been the area that has had the most focus for the longest time within ESG circles and fundamental analysis. But I really think it still is at the forefront as being a key enabler of other initiatives and a key core of the environmental and social analysis of an issuer.
I mean, that seems like a really good place to kind of close up the discussion. I had one more question that was looking more at, if for the future of the industry, do you see metals and mining companies, being priced differently depending on their ESG and carbon performance?
I think it's a great question, Amy, and to an extent we're already seeing that in the debt market. If we think about the reduced demand from the bank sector for loans to the thermal coal space, and that's resulting in a loan price premium to the coal sector. So there is an element of that that's already playing out. And then the other important aspect is some of the financial instruments that we now have, such as green loans and green bonds and sustainability-linked loans and sustainability-linked bonds. And I think we'll see increasing commitments from the mining sector to utilize these products, both as a communication tool to the investment community and to stakeholders on companies' commitments around ESG matters, but also that question around, well, we see incorporated in them, a bonus-malus mechanism, particularly in the sustainability-linked products, for meeting or not meeting ESG KPIs. So we are sort of seeing an element of this already being borne out in the market around both being able to attract liquidity and if not able to, what that means in terms of people having to pay a price premium, but also just the sheer attractiveness of those products that are linked to companies' ESG goals, and therefore a lot of liquidity available. If we look at the green bond market, absolutely the number of funds out there that have got mandates to invest in that space, and then how that's translating. And so I think what we'll increasingly see in the mining and metals sector is companies making those commitments and really aligning their financing strategy with their ESG strategy and using that to convey to the market and attract liquidity from the market, both debt and equity, to be able to I guess, get the best pricing that they can for themselves.
I can completely agree with that. And the only thing I would add is that we're starting to hear talk of on the product side of a potential premium or market access from products that are manufactured in a green way. And so this is looking at if you are a input provider of rare earths or materials which go into end consumer products where the consumer cares about the environmental footprint, does that lead to decommoditization of commodities, where you start having a premium for these products or access to different pools of demand, which are excluded if you don't meet certain ESG criteria and thresholds? And so I've heard discussions about it and heard anecdotal feedback that it's starting to happen, but haven't seen a wholesale examples of large amounts of flow being dictated under those terms. But for me, that's a really exciting area to potentially look at, as it also highlights not only the liquidity side of it and access to finance, but also the market opportunity from meeting these sorts of requirements.
Yeah, I just add to that, Gabriel, that we are starting to see elements of that. If you look at the aluminium space as an example, you can actually go out and buy zero carbon aluminium. And, you know, so whether or not we do see that decommoditization, as you put it, of commodities, as people will produce a green product versus a non-green product. And as we are seeing more and more interest from the OEMs, from the end users, of wanting to have that provenance of the minerals coming through in their goods, and that willingness to pay a premium. And you know, we've got things such as CBAM coming into play in Europe as well, so that carbon border adjustment mechanism, what that ends up meaning for the way that different products get priced as well is going to be really interesting. So yeah, I think that's certainly something going into the future that we'll see more and more.
Definitely. Just to quickly add to that, Amy, I think great points, Gabriel and Deb, particularly on the green bond side. When we've looked at the premium being paid for green bonds, actually we've seen a modest premium. It's very modest, actually, particularly when we look across the board at things like, you know, high yield debt, for example. So we would certainly expect that those premiums to expand going forward. At the moment, I guess it's pretty nascent sort of industry. So, you know, we are seeing increasingly opportunities to deepen our exposure in the green bonds market. You know, from our asset allocation perspective, you know, we in our sustainable asset allocations, you know, we use World Bank bonds as a sort of a benchmark for us within the fixed income space, within those portfolios. And then increasingly, you've got these, you know, greater opportunities and deeper markets in things like green bonds and some of the sustainable finance opportunities that are now starting to come to market. These are going to be key because what we know is that infrastructure and reducing carbon in infrastructure is going to be incredibly important. One of the things I got from the IPCC report earlier this year was they've almost pivoted their focus from mitigation, which seems to get most of the traction from a funding side, to adaptation. And I think for a lot of vulnerable communities, adaptation is going to be equally as important as for the major economies, who are the major emitters, to be mitigating those emissions. So certainly areas in sustainable finance to provide funding to, you know, these long-term projects, which traditionally have tended to be focused on government funding or funding from global organisations like the IMF and so forth. I think increasingly private sector operators are going to want to get some exposure to that. The only other bit I would probably mention is around, you know, carbon trading. You know, we are hearing a lot about voluntary carbon markets. Also, you know, China has an early functioning, you know, carbon emissions trading scheme. Europe, of course, has probably one of the longest running markets. There's definitely a lot more interest from clients. But at the same time, there's a lot of conjecture around, you know, buying carbon credits, is that really having the impact on the environment or the desired impact. I think definitely as we sort of move down the transition path that Gabrielle explained far more eloquently than I did, I think that as we move down that path, using carbon credits or trading in carbon, agriculture, mining in particular, which held large amounts of land area in many locations, can benefit from some of these opportunities. And I think that's one of the other elements where it's not just institutional clients wanting to get involved in holding credits or offsetting their emissions, but also private clients are wishing to do that as well. And so we've seen a significant pickup in that activity alongside of the green bonds and sustainable finance opportunities that Deb and Gabrielle talked about.
Yeah, and I think that's a really great point, Wayne, and just bringing back to what you were saying in terms of supporting the energy transition, because I believe at the end of the day, that's ultimately what we're seeking to do is to have a positive impact through our activities. So working with, for us, our mining and metals clients to help them in terms of being on that transition pathway, being, on the ESG messaging. So whether it's, some of the work we do with the steel sector on decarbonisation, and we're co-leading a climate-aligned finance agreement to really help the steel sector there. So at the end of the day, when we look at ESG, I believe it is about, how are we generating that positive impact, and looking again at things such as sustainability-linked loans, where the volumes that we saw in the first half of this year were greater than the volumes that we saw in all of last year, and that applied, globally. If you look at the market in APAC, in Europe, in the Americas, and we're just going to see that continuing to accelerate. So not necessarily so much looking at what's the benefit, if you like, of doing these ESG financing instruments, but I think looking at the future of the industry, the point that we will get to is for the companies that haven't set their KPIs, haven't aligned their financings with being green or sustainability, it's going to become more a question of what's the penalty that they pay for having not done so. As we move forward and these really start to become the mainstream financing instruments that people are using.
Yeah, that's a really interesting point in terms of penalties versus benefits. I think that should be a really good place to round things out. That was a really interesting discussion looking at the future of ESG for the industry. So I want to thank all of our panelists for taking part today. And we hope to see you all again soon. Live events should be happening in 2022. And so, yeah, we're definitely looking forward to getting off the ground again soon.
Perfect. Thanks so much, Amy. Look forward to seeing people in person. Good to see you, Gabrielle and Wayne.
Yes. Thanks, Amy.
Hi, thank you.
Yeah, nice to see you, Deb. Nice to see you, Gabrielle.